Okay, let's look at the data. Sometimes the most compelling opportunities, they aren't screaming at you from the headlines. They're hidden, right there, in plain sight, inside the market's own pricing. Today, we're going to break down an anomaly that the big institutions are actively trading and see exactly how it creates a potential edge for the rest of us.
So, it all starts with a signal. The data starts showing these significant, institutional-sized trades popping up. I mean, look at this. A single block of 15,000 short calls on ASHR. Now, that's not just random retail noise. That's a clear signal that the big players are making very specific, very directed bets on volatility. And here's the thing, it's not just about one ticker. This is a pattern we're seeing.
And this is where that divergence, that pattern, becomes crystal clear. We can actually quantify it. You can see right here that certain options, like on SLV with a call premium of 1.04 or Adobe at 0.86, they're priced with an incredibly high premium. This isn't a guess, it's a hard number, telling us the market is willing to pay a massive price for just the chance of a big move up. Now, that is a data point that should make you sit up and pay attention. So what is this divergence we're talking about? Well, it's quantified by a concept called the Volatility Premium. And in simple terms, it's just the gap between an option's implied volatility, that's what the market thinks is going to happen, and the stock's historical volatility, what has actually been happening. You can think of it as the fear and greed tax. It's the extra price traders are paying for what they expect to happen. And understanding this is the key to this whole anomaly.
So, the crucial point, the absolute bottom line, is this powerful disconnect. On one hand, you've got the options market pricing in these huge, explosive, lottery ticket moves. But on the other hand, you have the underlying stock's actual history, its reality, which is often way more stable, way more boring. This gap, this chasm between expectation and reality, that's where the opportunity lives. Now let's be very, very clear about something. This is not some conspiracy. This isn't about hedge funds cheating the system. What you're seeing is a structural feature of the market. You've got massive institutions constantly hedging their giant portfolios or making these huge speculative bets. And in doing that, they often overpay for options, which creates this inflated premium. For an agile trader, this isn't something you fight. It's a flow you learn to understand and maybe even trade against. And what this all leads to is a clear, repeatable strategy. This isn't about guesswork, it's a process. First, you identify these tickers where the implied volatility is way higher than the historical. Second, you analyze. You look at the underlying stock and ask, is there a real catalyst that justifies this price? Third, if there isn't, you can execute a trade to sell that overpriced premium, like selling a call or a call spread. And most importantly, you manage that position like a pro, with a clearly defined risk and a solid exit plan from the start. Now, here's why this is so compelling. This strategy actually gives the seller a distinct edge. You have three powerful forces literally working in your favor. First up, Theta Decay. Every single day that ticks by, that option loses a little bit of value, and that goes right into your pocket. Second, a Volatility Crush. If that massive move everyone's paying for doesn't happen, the implied volatility just collapses, and the premium you sold evaporates. And third, Mean Reversion. Volatility usually doesn't stay crazy high forever. It tends to revert back to its average. You're basically betting that the future will look more like the past than the options market thinks. However, and this is a big however, a professional approach means we have to look at the other side of the coin. The risks here are very real, and they can be significant. Selling a naked call, for example, has theoretically unlimited loss potential. A sudden unexpected catalyst or a violent short squeeze can turn a high probability trade into a catastrophic loss in the blink of an eye. This is exactly why risk management isn't just a good idea, it's an absolute requirement for the strategy. So this leaves us with a really crucial question, one you have to ask yourself. Is this persistent gap we're seeing between the implied and the historical volatility, is it a market error, a bug that's going to get fixed eventually? Or is it an essential feature of our market structure, one that provides liquidity and, in turn, creates these systematic opportunities for those who know exactly where to look? We are tracking these flows in real time. While you analyze the next move, check out the tools in the description. Sign up for Public to get $20 in free assets, check Webull for that BTC promo, or look into NVDA on Moomoo. Links are down below. Like and subscribe for more deep dive analysis.
And of course, always remember, this analysis is for educational purposes only. It's based on current data, and that data can change incredibly fast. So always do your own due diligence. Stay disciplined, stay liquid.